But let's broaden out the discussion here when it comes to markets to kick things off in the back half of the show today, because we are still underway when it comes to this debate around growth. Some of the FANG names catching some more steam here at perhaps some expense here coming from the value side of the trade. And for more on that, I want to bring on Chris Wallis, Vaughan Nelson Investment Management CEO, CIO, and Senior Portfolio Manager here, joining us today. And Chris, good to be chatting again. I mean, when we look at it, the traditional playbook may have been just to lean into some of those FANG names, hang out there. If we do see interest rates coming down, though, I mean, I imagine that would be a boost. How are you seeing maybe how this rotation is playing out now?
Yeah, I think it's generally the right direction, but it may not repeat like it has in prior cyclical slowdowns. The contextual setup's just a little different. We're going to have stickier inflation. You were talking just previously about wage pressures at FedEx. When you look at inflation in general, the three most important things really are labor, oil, and housing, and all of those are sticky. And we're seeing wage pressures across the board. So it does mean the Fed's going to have a little less room to move. And, when we do have a slowdown, it's not going to be in the context of falling commodity prices. And so oil may be moving higher. That may help out part of the value side of the equation, but not broadly. And the knee-jerk reaction to go back into secular growers that have higher PEs may or may not work. We'll have to see if that plays out this cycle.
And Chris, as we look ahead to the heart of earnings season, how do you anticipate those wage pressures to be reflected in the balance sheets of these companies? I mean, how significantly are they likely to be?
We're going to see it, and we're going to see it called out on earnings calls. And I don't think we're at a point yet where it'll start to impact guidance. We're still fairly early in the slowdown, as you mentioned regarding Nike and others. There's still a lot of room to drive margins higher or deal with some of these shorter-term cost increases. It'll start to play out on the margin and just from a rate of change standpoint. So investors may start fading some of the earnings strength we see in the second quarter. If wages do prove to be sticky, like I think they will, it may be a bigger issue as we move into 2022 and the slowdown broadens out. And you're not going to have, a low level of inventories like we've had. We'll see more discounting, and it'll be a bigger issue as we move across the calendar.
Yeah, at the same time, I mean, we've been watching the VIX decline here, and now at about 15. You got some out there, Fundstrat, saying that it's more signals to see maybe us hit 2,400 there on the S&P 500 or we extend those all-time highs. How do you see that playing in? I mean, if this volatility is expected to continue declining on a sector-by-sector basis, I mean, which ones are you leaning into?
Yeah, so when I look at like the volatility we had last week, it looks very transitory. There's no question the Fed shocked the market a little bit with the interest on excess reserves moving higher. That changed where some funding sources were from an overnight collateral standpoint, creates volatility. But as you mentioned, when you really look at vol across multiple sectors, it's been in a downtrend all quarter, and it continues to be in that downtrend. And while growth is peaked and liquidity is peaked, they're both still relatively healthy. It may be more difficult to get to new highs, but there's nothing that says we're not going to go on to new highs across the board over the next several weeks and months. It depends when we see this current slowdown we're in. Does it broaden out? Does the inflationary cycle start to follow suit? In other words, the upward pressure we're seeing now start to reverse? If that's the case and it really proves transitory, we'll probably see the yield curve remain well behaved. We'll see, stock buybacks come into place, high yields still hitting all-time highs. So I'm not broadly concerned about the market. It wouldn't surprise me at all to see us go on to all-time highs.
How do you play some of those variables, though? What's the hedge against inflation, if that's something that you see sticking around?
Yeah, I think the biggest threat to the market in general really is oil prices. When you look at those three factors, labor, housing, and oil, which are all three really important for inflation, and inflation is the one key that can really impact or box in the Fed. And when you lay them all out, the one area that's still very inexpensive is oil and energy. We've seen a rollover in the soft commodities and a lot of the industrial metals. Those stocks, while they may look cheap on a PE basis, they're probably trading at near-term peak earnings, and we haven't quite transitioned to the new secular bull move in commodities. Oil, on the other hand, is on a very different cycle. we way underinvested in oil for the 2 or 3 years going into the pandemic. The pandemic provided a reprieve. We're no longer have that benefit. Demand's coming back, and we need to spark investment and need to do it in a material way. And when you need to balance a market that's undersupplied, you do it with higher prices. And the stocks still trade at a steep discount to current oil prices. And I think current oil prices are going to be here to stay.
Yeah, that's kind of the surprising thing. I mean, there were a lot of people, a lot of fund managers out there kind of caught blindsided by the rebound in oil, had not allocated into energy. And you wonder how much that might be due to ESG concerns and whether or not they're just blocked. But when it comes to the remaining upside there, if we are to see oil prices continue to rise, I mean, it's already got a sizable lead, the energy sector, over the rest of them. I mean, how much bigger do you see that lead growing here in the back half of the year?
It really depends on the specific areas. I think you rightly bring up ESG has been a concern, and it's been an area where people think they really don't need to invest. But the reality is physics and economics are going to come into play, and we've got to invest heavily in fossil fuels if we want to make the transition to renewable energy. We can't get around that. I look for torque. I really want exposure to higher oil prices. So I'd focus more on E&P rather than service. I would probably shy away from onshore service-oriented entities because they're oversupplied. So offshore service, and then E&Ps that really have leverage. I wouldn't be afraid of a little balance sheet leverage in companies that are a little on the smaller side. You're not going to get the highest return out of an Exxon. You need to go down cap to do it. And these stocks still have, 35% and some can double from here if we really do stay at 70 plus for the next several years.
Chris Wallis, Vaughan Nelson Investment Management CEO, CIO, and Senior Portfolio Manager. Good to talk to you today.